Hi, everybody, and welcome back to FANG Friday. This is Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol & Associates Asset Management. Today, I'm going to raise an issue which you may or may not have considered. When I show you a chart and give you a reading on those breakpoint values, how accurate are those readings? And this is very important, certainly to me, but should be to you as well, as our SVA buy and sell action signals that I convey to you every week hinge directly on those readings. You need to be able to trust those readings if you are going to act and actually invest or withdraw investment capital based on those numbers. I mean, are we within the ballpark, sort of, okay-ish, or pretty much right on the mark? Well, the answer is that we are pretty much right dead on the mark. Every balance sheet is updated and adjusted daily, and the SVA charts are then updated at the close of business every day. Not weekly, not monthly, or worse, quarterly, but daily. So the main problem that we at SAC face in assuming the accuracy which investors require is the company more or less staying on track and not making large unexpected changes to the balance sheet, or are those balance sheet values actually all over the map? Well, the answer is that our own long-term evidence shows that our values fall within a very narrow margin of accuracy, and this gives us confidence that when we calculate a new valuation for the coming day, that we're within a very narrow band of confidence that the numbers are pretty dead accurate. Therefore, and notably, for instance, when we look at Apple, as we will in a moment, and see that questionable things may be happening, including intense regulatory scrutiny, how ready should you be? How concerned should you be that near-term action may well be required? Anyway, with this in mind, without further ado, let's take a closer look at those FANGs and what went on in the past week. But as always, before I do like to say thanks to everyone who likes this video and all our subscribers. It really helps to grow our channel, and we appreciate it greatly. Okay, we'll start with Amazon, which is just cheerfully sort of splitting the uprights, as it were, and coming right down the down the middle. It looks very much to me as if it wants to finish a move to its HB1, and usually when you get a nice breakout like this, that's what happens. I'm very happy to hold this stock. Same thing goes for Netflix. By the way, you notice that we've had gaps. Well, if we get another gap, we're going to finish the job to the HB2, all right, which is 12 times book. The question being is that going to be enough, or is the stock going to go further on? For now, let's hold this stock. Alphabet, well, you see it's had a third bounce on its MSG price. That's 5.5 times book value. I'm not sure that the stock has enough oomph to get to its bubble price again. However, if it can just float along its MSG price, you know, it's growing at about a 12.5% annualized rate. Not the worst kind of return that one might expect. Microsoft is banging up against its HB2. That's 12 times book. And looking as if it might want to break out. However, it isn't doing that yet. And as you know, the company has been fairly cautious about its AI exposure and what's going to happen. However, It looks very much to me as if that's what it wants to do. Now, I would only be holding the stock right now. If it breaks out, however, I would definitely buy and double down on my exposure to this company. Meta appears to have broken out nicely. It's holding above its bubble price, again 7.4 times book value. And what are we looking for? Well, look at what happened the last time that the company reported and the stock gapped up. If that company has another strong quarter, as I think many people, including myself, expect, I think we can move and expect that this company is going to probably get at least to its HB1, and that's 9.5 times book. NVIDIA is, I'm not sure that I would call it struggling, but it certainly is not trading confidently above its HB7 price, which is 43 times book value. The stock is very, very expensive, and you can see recently that the analysts have slowed down their rate of earnings gains. For now, we would definitely want to hold this company, but I think we are watching carefully to see if it can break out. Now, of the two companies that are not performing very well, the first is Apple, and that fell down to its HB5, which is 26 times book value. Now, remember I said if it falls there, that is good support, and you may want to buy the company, the stock, because after all, it's had a fair decline in value, in price. Well, so far, the HB5 has held until yesterday, when it dropped very slightly below that breakpoint value. Now, remember my 3% 5-day rule? It certainly has not violated that, so I don't have a sell on Apple, but I do have to observe that we've at least got a warning shot fired at us. And finally, Tesla. It almost came down to its bubble price and then had a little bounce. Just very much, by the way it did back in 2022. Almost got there, rallied, and then dropped to its bubble price and held beautifully. So we want to watch Tesla very, very carefully. Of course, the thing that concerns me is the outlook for the electrical vehicle market. But for now, we'll just watch the stock very, very carefully. Now, to briefly recap, Amazon and Netflix appear to be in comfortably rising trends. After a little flutter of concern, they're being rejoined by Alphabet, which has moved back on side. Microsoft is also in a nice rising trend, but as you saw, is getting to a point of decision at its HB2 price. A breakout would mean that I, for one, would double down on the shares. Of the two hot story stocks, Meta looks to me as if it is safely over its bubble price, that's 7.4 times book. By the way, 7.4 times book, that's a funny sort of number, isn't it? How did we ever get there? Well, allow me to elaborate. It's not statistics. Mathematically, that is 1 divided by the Napierian growth constant E squared. NVIDIA, the stock that everyone loves, is struggling at its HB7 price of 43 times book. I have to observe that not since the dot-com era have I seen such a scramble to try to forecast just how high these shares will go. It does make one want to reflect, doesn't it? As for the two poorly performing FANGs. Apple has been sitting on top of its HB5, that's 26 times book, for 3 weeks now, and yesterday it slipped a little bit below, at least for the moment. No sales and earnings growth, no dividend to speak of, and a lot of possible regulatory hassle makes me nervous. Watch closely if you bought it on spec, as I suggested when it fell down to its HB5 level. Finally, Tesla fell almost to its own bubble price and has had a little bounce, as it did the last time it fell that low, before finding its feet right at its bubble price. Can it do it again? This is definitely very close to a fill or kill moment, and all I can advise is to wait and see. In total, I'd want to be owning Amazon, Netflix, and Alphabet in my FANG portfolio. I would add Microsoft to the mix, and I would want to be adding to my position if the stocks can break out here. I would be adding to or buying Meta here, and probably Nvidia, although a bit nervously, as we do not have a clean breakout so far. Apple and Tesla remain in my bad books from a fundamental point of view, but as I said, support is support, and both are now at critical decision points. As far as Apple is concerned, I'm only one vote among a gazillion investors, millions of whom are Apple product users and fans. Anyway, keep an eye on both stocks. For now, this has been Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools. I will see you next Friday.